Well, good morning, everyone. Welcome to MHA's Private Client and Entrepreneurial Business take on this year's second budget, or last week's autumn budget, we should say. My name is Patrick King. I'm a tax partner in McIntyre Hudson, and I'm joined today, as usual, by James Kipping, another tax partner in MH. We have been doing a series of these webinars on private client and entrepreneurial business matters, and so what we're going to try and do today is give some slant from that side of things on what Mr. Sunak said last week. Now, Mr. Sunak said he would deliver a technical budget. Of course, it's a bit unclear what a technical budget means, so we weren't sure what we were going to get. We had fears of significant changes. But I think it's fair to say that no one was expecting quite what he did do. And there weren't very many tax changes, very few. As a tax person, there was very little to hear, but there were one or two, which we shall go through. What there was massive largesse. Mr. Sunak gave money here, he gave money there, he gave money everywhere. And as I was listening to it, I was steadily growing in dread as to when we're going to get the taxing part of the whole equation and where's the money's going to come from. But there just wasn't anything, or very little. Of course, he has already raised a lot of tax in the March budget, which will come through in not too distant future. And we will just cover a few of the main points there as well as we're going on. But there was relatively small amounts in this budget today. We will cover them, and of course, as ever, the fact there's very few apparent changes doesn't necessarily tell the whole story, so we will try and cover that. What we're going to do this time, because there was so little actually in the budget, instead of doing our usual 100 slides, running through very, very quickly and trying to get everything across to you in short order, we are going to have a much shorter, probably about 15 minutes presentation with a few slides covering the main changes and the main points from the last budget, and just a few things we've thought of. And then that'll probably be about 15 minutes or so, and then we'll open it up to a much longer than normal Q&A session. So please fire in as many questions as you like. It can be on the budget, hopefully it will be on the budgets this year, but to be honest, we'll have a go at answering questions generally on tax matters. And see how we get on. We've got quite a few questions already that have come in, so we'll work through those, but please fire in any thoughts you have, and we'll see what we can do. And on that note, I shall hand you over now to James to take you through the private client side of things.
Thank you, Patrick. Morning, everyone. As Patrick said, this will be relatively brief, but hopefully a few pointers and reminders nonetheless. I'll start with a reminder of the current income tax thresholds, really because we now know that those thresholds are frozen for the next 5 years, so right through to 6th of April 2026. The impact of this freeze will be demonstrated in a moment with an example, but just to quickly run through, obviously everyone's entitled, well, most people are entitled to the personal allowance of 12,570, and that's an income in that band isn't taxed. That personal allowance is taken away as income increases above 100,000, and I'll come on to the impact of that in a moment. The next 37,700 of income is taxable at the basic rate, which the normal rate is 20%, but for dividends is slightly lower at 7.5%. And then the higher rate applies above 52,70 at 40%, or 32.5% for dividends. And the additional rate of 45%, or again 38.1% for dividends, applies to income above £150,000. That's the kind of high level summary of income tax rates. You see on the right hand side of the slide that the dividend tax rate increases by 1.25% next April, so April 2022, to match the corresponding increase to national insurance, or rather the social care levy as it will be called, from 2023. Now, the reason the dividend tax rate was increased was so that the social care levy cannot be avoided by people paying themselves dividends from their personal companies rather than, say, a salary. Move on to the next slide. So here I'm trying to demonstrate the impact of fiscal drag, or rather the fiscal drag effect on the freezing of income tax thresholds whilst incomes are rising, particularly with the effect of inflation. So if the example I've got on the slide here, and actually this slide should have changed, apologies, I've got the wrong slide on the screen. What I was aiming to demonstrate was that someone with a salary of £60,000 in the current year has a tax liability of 11,432, that tax liability actually remains the same. So ignore the number on the slide here, right through to 2025, 26. But if you inflate their salary, so if you inflate the salary by 2% per annum, inflationary increases, so the real value of their income is unchanged, the income tax liability in 2025-26 will be £2,000 higher. And now the effect of that, and this is not on the slide here, it's on the copy I've got in front of me, that the proportion of income taxed at 40% increases, and it increases from 32% up to 42%. So over the next 5 years, a greater proportion of people's incomes are likely to be taxed at higher rates of tax, or in many instances, people will be pushed into higher rates of tax because of the impact of fiscal drag. The final point on the slide here, not entirely related, but it's income tax related nevertheless, is that making tax digital for income tax self-assessment has been deferred until 6th of April 2024. We were expecting it to come in from April 23. Yeah. Is there much more to say at this point? Probably not, other than we will be contacting clients as planned early next year, where we believe they'll be affected by making tax digital. And this is the move by HMRC to require businesses, or rather sole traders, partnerships, partners, and landlords to report their income quarterly, in addition to the annual self-assessment tax return. The long-term view here must surely be with a view to collecting tax earlier, but we haven't got to that stage just yet. The next slide. This here I'm showing what, or rather, so-called marginal tax rate traps. So, using an example, if there's an individual with 2 children, and that's important for a reason I'll come to explain in a moment, earning 160,000 in the current tax year, that individual will lose all their personal allowance because their income is well above 100,000, and they will lose entitlement to child benefit because their income again is well above the £50,000 threshold. But in terms of their marginal tax rates at different bands of income, it's quite interesting to look at the table here. So on the first 37,700, they'll pay 20% and then move up to 40%. But because the impact of the removal of the child benefit, where income exceeds the basic rate threshold, means that between broadly 50 and 60,000, they're paying a marginal rate of 58% income tax. That then drops back to 40% between 60 and 100. But then between 100 and I should say 125, the effect of the reduction or abatement of the personal allowance means that income within that small band above 100,000 is actually taxed at 60%. And when you consider that national insurance is added to that, people with employment income or earned income above 100,000 are paying 62% effective rate of tax in that small band between 100 and about 125. And then we fall back to 40% and 45% below and above 150,000. I suppose what this highlights is the benefit of doing some planning, particularly if you're in those bands where you're paying in a very high effective rate of tax. So take an example, someone with income of between 100 and 125,000 will pay a marginal rate of 60%, as I've said, plus 2% national insurance. So correspondingly, the tax relief available on, say, pension contributions, for example, is also 60%. So for someone in that marginal rate of tax, the net cost of a 10 grand pension contribution will actually only be £4,000. So for those people in those sort of high effective rate bands of income, things like pension contributions, charitable donations, and timing them correctly is really important. Basis periods. This is another change that we knew was coming. It wasn't announced last week. It was announced previously. But it is something that will affect the way that profits are taxed for unincorporated businesses from April 2024. Currently, a business pays tax on its profits for the accounting period ending in the tax year. So, for example, if a business has a 30th of September year end, the profits for the year ended 30th of September 2021 will be taxable in the tax year 21-22. So choosing a year end other than 31st of March or 5th of April to be coterminous with the tax year could delay when tax payments are due. For example, many professional practices historically have had accounting dates of 30th of April. So you can see that many months can pass between the 30th of April and when the tax payments are actually due. From April 2024, businesses will be taxed on profits arising in the tax year. And 2023-24 will be the transitional year. So in that year, businesses will be taxed on a long period right through to 5th of April 2024. So in my example given previously, if the business has an accounting period ending 30th of September 2023, in 23-24 they will be taxed on 18 months of profits right through to the end of March, beginning of April 2024. And at the same time, they'll be given relief for what we call overlap profits that they've brought forward. Now, overlap profits are kind of profits that were taxed twice or have been taxed twice when the business commenced, or when, for example, a partner became a partner in a partnership. I won't go into technical detail on that. Again, as an example, though, this kind of follows on from the example I gave a moment ago. If we have a 30th of September year end and their profits for the year to 30th of September 2023 are £100,000, in 23-24 we'll have to add another 6 months worth of profit to that, so that excuse me, in the tax year 23-24 we're taxed on £150,000 worth of profit. If overlap profits are, say, £20,000, the taxable profit is £130,000 as opposed to 100 that it would currently be under the current rules. The transitional relief will allow that additional 30,000, rather the tax on that additional 30,000 pounds to be paid over 5 years. But you can see here again, this whole move has an element of simplification about it, but it will also bring forward when tax is payable for many businesses who currently don't have accounting dates that are coterminous with the tax year. Capital taxes, capital gains tax. Well, we were expecting, as we have been for some time actually, changes to capital gains tax rates. Currently, the main rate of capital gains tax is 20% or 28% on gains made on the disposal of residential properties. And there was a suggestion, more than a suggestion really, that it was thought likely that at some point, perhaps still in a future budget, we'll see an increase to those rates. It's even been said they might be aligned with income tax rates, but we'll wait and see. But nevertheless, I suppose the message is probably still take advantage of the current lowish rates of capital gains tax if you can. The annual exemption for capital gains remains at £12,300, and it will remain so through to April 2026. So again, that sort of fiscal drag effect will be evident. There was talk that the annual exemption might actually be decreased. So in many ways, it's a positive that we've remained at £12,300. And that annual exemption, just to be clear, is the amount of capital gains that someone can realise in a tax year without, or rather before, paying capital gains tax. There's no increase or changes rather announced to business asset disposal relief, or rather, entrepreneurs relief, as many people still refer to it as. That's sorry, I got bad throat this morning. That's the relief that allows CGT to be paid at 10% on the first million of qualifying gains, and that's broadly the disposal of business assets, or rather material disposals of business assets. The one change that was announced last week was the extension of the reporting and payment of capital gains tax on disposal of UK land and property. So at the moment, where residential property is sold, we have to make a capital gains tax return separate to the normal self-assessment tax return. Previously, that was due within 30 days of completion. It's now due within 60 days, and that's for completions on or after 27th of October 2021. So really, just as we've got to grips with the system and managed to get to a position where we can quite easily submit them within 30 days, we've been given an extension which actually would have been quite useful in the opening years of these returns, but there you go. And just a reminder that where someone sells a mixed use property, so a property that is both residential and commercial, perhaps a shop with a flat above, then it's only the residential element of the gain that needs to be reported. Just obviously adding some complication to that initial return doesn't change the fact that the whole gain needs to be reported on the self-assessment return. I'm increasingly frustrated with this sort of 30 or rather 60-day return. It just seems to add a level of administration which is largely, in my view, unnecessary. But there you go. Inheritance tax. Again, this is an area where we didn't see any changes, and we knew we probably wouldn't see any changes to things like the inheritance tax nil rate band, which has remained at 325,000, and by the time it's been frozen at 325,000 until 2026, and at that time it will have remained the same for 16 years. So I had a quick look back. Because again, this freezing of the nil rate band for so long brings many more estates within inheritance tax. And I had a look back at average house prices in 2009 when the nil rate band became £325,000. And at that time, the average price was 155,000 or slightly above. It's now 264,000. And presumably it will be higher still in 2026. Of course, we do now have the residence nil rate band, which is available to those people who are able to leave their main home to direct descendants. So in many ways, that's softened the blow as compared to back in 2009. But nevertheless, the freezing of allowances will bring more and more estates within the charge to inheritance tax between now and 2026. The final point there is just to confirm there's no changes to reliefs available for inheritance tax. I say that because we are, again, sort of speculating, if not expecting, that at in some future budget we probably will see business property relief as an example, and possibly agricultural property relief tightened somewhat. We've gone through that, or rather explained our kind of thoughts on that in previous webinars, and so I won't go into any detail now. But again, certainly the reliefs as they stand are very generous. Pensions, and I believe this is my final or penultimate slide. Again, no changes were announced, but because we knew already that the lifetime allowance, and that's the maximum value of someone's pension fund sorry, how to explain the lifetime allowance? Where someone's pension fund exceeds the lifetime allowance, then there's a lifetime allowance charge at certain benefit crystallization events, such as when you take benefits from your pension or when you reach age 65. Now, we know that the lifetime allowance has been frozen through to 6th of April 2026. So again, this fiscal drag effect will bring more and more people within lifetime allowance charges by 2026, particularly if people have planned pension contributions in the expectation that the lifetime allowance will increase in line with inflation, as was previously promised. No changes to higher rate tax relief on pensions. I say that because one of the areas where we've speculated there'd be changes for many years are restriction to tax relief on contributions. Pensions tax relief costs the government about 40 billion a year. So in terms of kind of taxes that affect private clients, or tax reliefs that affect private clients, this would have a big impact if they were to restrict the higher rate tax relief available. To some extent, they have done so in the past already by reducing the annual allowance down to now 40,000. So that's the maximum that someone can contribute in any given year, subject to being able to bring forward unused allowances, etc., and get tax relief. And the final point on the slide here is just to say that the ability to access personal pensions will move from age 55 to age 57 with effect from April 2028. Again, we knew that was coming in. And the final slide here, I've got stamp duty land tax, just really a reminder, there's no change to the rates here, but just really a reminder that from 1st of October, the stamp duty holiday that applied to residential property purchases is now a thing of the past. So we're back to the rates that applied before that kind of stimulus measure was introduced last year. And on that note, I probably talked for too long, so I'll hand over to Patrick. Thank you.
Yes, thanks, James. Yes, I said at the start that I thought we'd be talking for about 15 minutes. Well, clearly we're going to be talking a bit longer than that, but there's less to say on the corporation tax non-private client side, so we will be getting to the question and answers fairly soon. Just before I kick off on corporation tax, I mentioned at the start that I'd been dreading during Mr. Sunak's speech the tax raising part of it. Just a little bit more on that. The reason I said that is that if you add up all the spending measures and then compare them to the tax raising measures that were announced back in March, including the social care levy, which is of course the big one, he's spent or promised to spend an awful lot more than those tax rises. So I think it's fair to say that it's reasonable to expect further tax rises in the future, although it may depend how much benefit Mr. Sunak gets from the fiscal drag measures that James has mentioned and inflation increases, which can help as well as hinder in some areas. So we'll have to wait and see, but I don't think it's unreasonable to anticipate further tax rises in the future. So all the areas we've been saying we're worried about, that James just mentioned, particularly the pension one, I think remain worthy of some concern. So moving on to corporation tax, there's quite a big rise coming in April 2023. We're jumping from the current 19% to 25%. So that's a big one-off rise, and you can see people being a bit peeved about it. But actually, when you look back in relatively recent history, or even quite distant history now, that is still a very low rate. And the slide shows that between 73 and 82, we had a 52% rate of corporation tax. And it was over 30% for many years following that as well. And only recently has it started coming down. And that has been in line with international trends. The general movement, the general direction of travel has been to reduce corporation tax rates. And in fact, 25% is roughly where the larger countries are ending up. It's not precisely 25%. 25% is still a fairly low rate when compared to our G7, G20 peers. Internationally, it's a pretty low rate. There are people lower, but 25 is not bad. So I think while it is a big increase, it's reasonable given the additional money that the government obviously had to raise given the COVID problem. The reintroduction of the small companies rate is something that we in the tax world didn't expect to see anytime soon. It's been there before, it was there for many years, but it was finally abolished a few years back. It's back, but on a much smaller scale. So companies with profits less than 50,000 will continue to be taxed at 19%. And then there'll be effectively a sliding scale between profits of 50,000 and 250,000, which takes them up to the full 25% rate. I'm not going to say any more about that, other than there is that lower rate for very small businesses. One change that did come into this budget was not so much corporation tax as an extra levy that's being introduced to target large UK residential property developers. I think it's easy to see why they have been targeted. No one gets too excited or worried about residential property developers. They are seen as people, a bit like banks, who've made lots of money in various regions, not entirely necessarily of their own doing, but because prices have been rising very rapidly. You can agree or disagree with that, but that does seem to be the general view. And so the government felt that it could get away with slapping an increase on them. The increase only applies to very large property developers. It's those making profits exceeding £25 million, and only the excess above 25 million will have to pay the extra levy. The extra levy is 4%. So large residential property developers will be paying up to 29% on their corporation tax rate from next April. So I wasn't sure whether that was a good thing or a bad thing in terms of the government wanting to increase the amount of properties being built. But I suppose if they're going to make it easier for residential property developers to develop more properties, they'll make more money, and therefore perhaps they can pay a bit more tax. I imagine that's the logic. Looking at reliefs and incentives, here's one of the little stings that was hidden away, I think, in what the Chancellor said. The good news on research and development is that he's spending loads of money in various areas, and including, it seems, at first sight, in research and development tax credits, which of course we've talked about many times and are very valuable, encouraging people to spend money on genuine R&D. What he did on the positive side was to expand the scope of R&D to include data and cloud computing costs, which had been absent before. So that's the good news. The not so good news is that while talking about R&D relief, Mr. Sunak mentioned that about £45.7 billion, I think, was spent by British companies on R&D in the last measured period. And of that, only 25.9 billion was spent actually in the UK. So what he was saying was that not far short of half the total R&D spend in the country was actually spent overseas. And what he announced last week was that he was going to restrict the R&D tax credit relief to UK-based expenditure. So you can see why he's doing that. He wants to encourage spending in the UK, and that's good for the UK economy. But if you look at it slightly more cynically, you could say in one fell swoop, he is effectively nearly halving the R&D tax credit cost to the Treasury, because about half the tax credits claimed, currently at least, are for overseas expenditure. We'll have to wait for the detail to see to what extent he does stop it, because obviously people have signed up for long-term projects, which they can't just pull out of. And there is some sort of R&D that you have to do overseas. It relates specifically to an overseas area, so you need to do it overseas. Will those still be allowed? We'll have to wait and see. We don't know yet. There was good news on capital allowances. The annual investment allowance, which is currently £1 million, but was due to reduce to 200 at the end of the year, is going to continue at £1 million for another year and a bit to the end of March 23, which aligns it neatly with the end of the super deduction that was one of the big stories in the March budget, of course. The super deduction allows 130% deduction for plant and machinery expenditure, most types, but not all, for new equipment up to the end of March 2023. And that effectively gives the company a 25% tax credit on plant and machinery expenditure. Now, why did he do that? Well, he did it to encourage spending, because the UK's expenditure on capital matters had reduced dramatically during the COVID crisis, as one might expect. But he did it also out of necessity, in a way, because having announced an increase in corporation tax of 25% from end of March 23, most companies would look at that carefully and think, well, I'm not going to incur capital costs and get relief at 20% or 19%, and I can wait a year or two and get relief at 25%. So what he did by introducing the super deduction was encourage spending, yes, but also he necessarily had to do it to allow people to think, let's spend the money now because the rate I'm getting in effect is the same as I will get if I wait until the 25% tax rate. That's the effect of the numbers. What benefit do you get from the AIA then? Well, there's a couple. Firstly, the super deduction only applies to corporates, so non-corporates don't get it. But the AIA is available for everyone, so it's good for non-corporates. But also, the super deduction doesn't apply to second-hand assets, and you don't get a super deduction as such for special rate pool items either. So for either second-hand or special rate pool items, even corporates will want to use their AIA in preference to the super deduction normally, if they possibly could. So they are good, they are temporary, and as we say at the bottom there, and as we say repeatedly with pensions and other things, use it or lose it, because it's not going to be there for very long. If we can go to the next slide, James, please. Oh yes, going into employment taxes. The big change here, of course, was the social care levy. manifesto busting increase in national insurance was, of course, how it was touted, and I don't think anyone would argue that's exactly what it was. I think Mr. Sunak was able to do it for several reasons. Firstly, of course, everyone understood that manifestos are written in normal times, and when you have a crisis of the magnitude of COVID-19, it's effectively put the country on a war footing, and no one expects everything to stay normal during a war. And the amount of money spent was very similar to a pretty decent-sized war, and therefore people were willing to let certain things go. There was also a general view in the country that social care did need fixing. It's been a problem for many, many years, and this does at least try to address it. And lastly, he will change it from being an increase in national insurance to a new tax in due course. So it won't actually be, the national insurance will go down again to the normal levels, but there'll be this extra tax called the social care levy at 1.25%. So that also allows people to get their heads around the idea of an increase in tax or increasing national insurance. Where we have to perhaps be slightly cautious is, as I mentioned a little earlier, Mr. Sunak has already spent more than the amount of money he raised on all his plans spending, as he announced last week. So we'd have to see, does it actually end up in social care? Hopefully it will. The other thing we have to worry about is it's very easy, of course, to say we're not going to increase tax and national insurance, and going forward he can now simply increase the social care levy, and he's not increasing tax on national insurance. So watch this space. I wouldn't be surprised if 1.25% does sneak upwards in due course. On the national, the other thing to say on that, of course, is this is an increase in tax effectively. So if you're in a position where you can take income before the 6th of April 2022, it makes sense to do so and get the current rates rather than the extra 1.25%. Moving on to national minimum wage, not really a lot to say there. As predicted, it has risen up to £9.50 now for 23 and overs. My son will be very pleased that the lower level will have gone up because he's currently doing a minimum wage job while he's at university. So seeing a 4% increase will make him happy. But other than that, it's an increasing cost of business, isn't it? And I think we're just going to have to expect this to continue. All parties are talking about increasing these allowances going forward, or these minimum wages going forwards. And we can only see that going one way. I can go to the next one, please. I think this is probably the last slide before we go into Q&A. Personal allowances, as James has said, things are being frozen, so they're staying the same, which gives us this fiscal drag matter. But if we look down to a few new announcements, the car and van fuel benefit charge, that's going to go up by CPI. So although we are freezing allowances, we are increasing some of the charges. So that's not particularly good. Van benefit the same. National insurance contributions thresholds are increasing, which is, I suppose, a good thing. Tax rates, pension relief, salary sacrifice, all areas we've talked about many times before where benefits can be taken. Particularly pensions, take it while you can because it's not going to last forever. It seems to keep defying us and continuing. There's no changes so far, but as I've said a couple of times, Mr. Sunak is going to need money unless the fiscal drag effect is so huge that it gets him out of that problem, or inflation inflates away some of his debt. He is going to have to raise more tax, and some of the areas we're worried about, we think, will come back to haunt us. And that, I think, is the end of the presentation part. So it took us just over half an hour rather than 15 minutes as I thought at the start. So apologies for that, but just goes to show there's more to talk about than you think. We now have roughly 25 minutes or so in our usual allotted time to take any questions. So if that's, we can open it up to anyone to send in some questions. And I know we have Steve in the background who is going to ask the questions that we've currently had, and we'll kick in with any new questions as and when they come in.
Thank you, Patrick. Yes, we do have a number of questions. Most actually aren't related to the budget at all, of course, as you would expect. One of the things, James, if I might ask you, you mentioned was taking advantage of capital gains tax rates while they're lower. So I've had a question, are there ways effectively, the question is, are there ways of creating a disposal now whilst rates are still low?
Yes, there are. It could be as simple as sort of transfers within the family in the right circumstances. You can also make transfers onto what we call self-settlement, so trusts for yourself. Again, in the right circumstances, that can work. So we've done that a few times where we've wanted to crystallize gains before, for example, someone comes back to the UK and becomes UK resident and therefore subject to the main UK CGT regime. So yes, there are 2 or 3 ways that it can be done.
Right, thank you. In a similar vein, I think most of the audience seem to be reasonably scared about the prospect of tax increases, and quite rightly so. So there are several questions related to transferring income-producing assets to spouses and that sort of area, if you wouldn't mind just giving us a quick rundown on the advantages of that. That would be helpful. Thank you.
Do you want me to start, Patrick? Perhaps
you might as well.
Jump in. Right, I mean, kind of the most straightforward sort of tax planning really for husband and wife is to typically with investment assets, so assets yielding investment income, we might look to ensure that that investment income arises in the most optimal way between them. So obvious one might be, let's say we've got an investment property. We would look to see which spouse has available personal allowances or basic rate tax bands or something, and ensure that we try and have the underlying ownership such that the income arises to the spouse who will pay the lowest rate of tax. With property, there's a kind of additional complication that the kind of default position is that spouses will share income jointly. So if the underlying ownership is made different, we have to make an election to ensure the tax treatment follows, but it's all relatively straightforward. Not sure that fully answers the question. Is there anything you want to add, Patrick?
Well, the only thing I'd add is you can go further than that. People have been known to obviously bring in wives, children, other relatives as employees in their businesses, which within reason you can do. There's always a temptation to pay a large salary to a child that doesn't ever turn up at work and never does anything. And if you do that, you are, of course, breaching the rules, because expenditure is only deductible by a business if it's incurred for the purposes of the business. So you do need to have some reasonable rationale for whatever levels of salary you pay family members. But it's fairly easy to justify relatively small salaries. You don't have to do an awful lot to earn £5,000 or £6,000, £10,000. So it's valid. You just have to be careful you don't go too far. We've seen people do that. And sometimes you get caught out by questions, but as long as you're reasonable, you should be okay.
Right, thank you. You mentioned property, and actually someone has asked about something you've mentioned a lot in the past, personal investment companies. I know they're not confined to property, but that's the context in which it's being asked. Is this something you still recommend?
Yeah, in the right circumstances. I think we need to at least bear in mind the increase in corporation tax. So if we're looking to simply compare tax payable by or within a corporate structure to tax payable with personal ownership, then that difference is obviously going to be narrowed somewhat. Having said that, that's not usually the only reason we would use a sort of family investment company or personal investment company. Usually there would be other benefits. For example, we might structure a family investment company with inheritance tax in mind, so that the share structure will include, let's say children, or trusts for grandchildren, or what have you. Yeah, I mean, I suppose as a rule of thumb, we would still say that personal investment companies can be very useful and can be very tax efficient, and will continue to be very tax efficient. Generally, we're probably looking at reasonably sizable sums available for investment before we say that this is really the route that someone should go. And I think, I was talking to Patrick yesterday about, well, okay, what sort of sums do people need before we would say this is really an option for people? I I would say as a guide that if we're going into things like stock market investments and what have you, probably a couple of million plus to invest is needed before we would say that, actually let's use a personal investment company rather than, or in addition to, kind of more vanilla planning. Property might be a little bit different. So because, for example, if someone is always going to be relatively heavily geared, then lower values might still point us towards a company to avoid the finance cost restrictions that would apply to personal ownership. But again, it's only a rule of thumb. I think it's one of those things you kind of have to look at everyone's circumstances individually.
Yeah, I think it's fair to say that the personal company is, or personal investment company is, as James said, still something that can be very, very advantageous. And we've talked about it many times. We've had a presentation specifically on it in our series. So we obviously think they're a great idea, but the truth is we don't do a vast number of them because there's a whole load of things we would do before we got to that level of complexity. And as James says, you do need to have quite significant amounts before it becomes worth the effort and the cost. But in the right circumstances, they're great.
Right, thank you very much. There's a broader question, something people might consider as an alternative to a personal investment company, and that's trusts. And the question is largely, are trusts still effective for tax purposes?
Yeah, right. Again, I'll start, shall I? And I'll
Go on.
ask you to make it clear. I think in many ways we would say that a personal investment company can do what a trust used to do before the changes to the trust rules in 2006. So where we're talking or thinking about quite large sums, trusts are now less flexible than they used to be, and therefore we might veer towards a personal investment company which can replicate a lot of the things that a trust does from an asset protection perspective, etc. That doesn't mean to say, however, that trusts are not effective and indeed tax efficient in the right circumstances. So where we are concerned with inheritance tax, such that we want to make a gift, for example, but we're also concerned about asset protection, trusts can be very, very useful. And the example I sort of give quite often, and this is something we're frequently asked about by clients, is where someone comes to us and says, look, I want to help my child or my grandchild get on the property ladder. I want to do some inheritance tax planning, but I don't really want to just write them a check for 300k or whatever it might be. In that instance, I would say, well, consider using a simple trust. So perhaps transfer in that example £300,000 onto a discretionary trust, and then have the discretionary trust loan the money on an interest-free basis to the beneficiary. Now, in that example, the trust provides the asset protection that the client is after, because of course, should the beneficiary get into financial difficulty or separation or divorce becomes an issue, then of course the trustees can call in the debt. But at the same time, that sum of £300,000 is below the threshold that will create immediate and ongoing inheritance tax charges, for example. So in that regard, that example keeps things simple. But at the same time, the client has made their gift and started that 7-year rule or 7-year clock for inheritance tax purposes. So hopefully that's a decent example of where trusts are still very useful, but that's by no means the only one. I don't know if you want to add anything, Patrick.
No, not really. I think we still use trusts quite regularly, don't we? I mean, I think the personal service company has certain advantages, as you mentioned, but one of the reasons we use that is where people just don't like trusts. Not everyone does. So a lot of people have had a bad experience with the trust in the past for whatever reason, and they don't like them. We still think they're very good, very useful, and they're still very effective.
Thank you. I think this is related to avoiding the traps, in other words, the cliff edges. I think perhaps you might refer to them, and it's a brief refresher on the unused pension relief rules.
Ah, yes. Well, yeah, the basic limit, and James, obviously jump in when and if I get things wrong, but the basic limit is you can put £40,000 or your income, the lower of £40,000 or your level of income into a pension each year. That's not entirely true, because if your income is above certain quite high levels, then you can't put as much as £40,000 in. But let's look at the main rules for this purpose. Most people can put in up to £40,000 per year. If you do not put in the whole of £40,000, the excess that you haven't used can be carried forward 3 years. Depends how you look at it, 3 or 4 years. Basically, you can carry forward 3 years worth of any unused relief you have and use it in the current year. So there's 4 years in total you look at any particular time. So you can see from that if you've, there's one more quirk. You do have to have had at some point a live pension fund, and it still needs to be active, even though you may not be putting any money into it. So provided you set something up as a student, put a couple of quid in it, and then didn't do anything at all with it, but kept it running, you can still do this. So let's say you've suddenly got lots of money and got a lot of income. You could, in theory, use the £40,000 from each of the previous 3 years, plus the £40,000 in the current year, if you have enough income, and make a huge pension contribution and get full deduction for it at your highest marginal rate. So that's how it works. But you do have to have that pension scheme in existence. We do occasionally come across people who haven't used any pension allowances, but they've got no pension and therefore they just can't do it. It's a bit of a strange one, that, but that's the way the rules work. So I don't know if that's everything, James, or you need to say anything else?
Yeah, I think that's just about everything, I think. Yeah.
Thank you. We have one question. It probably relates to the next seminar rather than this one, but how will the lower small profits rate for corporation taxes be applied when there is more than one company under the same control?
Well, I think it's divided, isn't it, between the companies? I mean, Steve, so you're a corporate man, really, but I mean, if I get this wrong, do chip in. But I think basically, if you've got more than one company under common control, and it is common control rather than group, so that's an error people can make. So if you own 2 companies, but they don't own each other, so they're not a group, you separately own 2 companies, but you own them both, then they are commonly controlled and therefore associated for this purpose. And the small company limit will be divided between those 2 companies. And it used to be the case that it was just divided equally. Am I right, Steve? That's still the case, or can you now allocate it?
No, it is still equally, and it's different to other tests as well, such as instalment payment tests, which is why it causes quite a lot of confusion. Yes, we have quite a few more questions. I don't know, have we run out of time, or would you like to keep going?
I think we've got about 10 minutes left for our normal allotted time, right. So I can keep going for the moment.
Okay, something that will horrify both of you, I'm sure. A client or a potential client says, I have no will. Should I seek tax advice before the will is drafted? In other words, which way around should I do it? This is quite a common question in practice. Should I go and see the solicitor first or the tax advisor first, I think?
Yeah, well, James and I had a chat about this very issue, funnily enough, yesterday. It's coincidental, but we were just talking about the situation of wills, and I slightly different viewpoints, but pretty much the same idea. From my point of view, the most important thing is that you've got a will. Any will is better than no will, virtually. And so if you're in a situation where you have reasonable value in your estates, you're a classic married couple, you have no wills, got a couple of children, fairly common situation, and it's surprisingly common how many people don't have wills. Then what I would say the most imperative thing is that you go down to a solicitor and get a simple will put in place immediately, leaving everything to each other and remainder to the children. If you do nothing else, that protects you from the worst ravages of not having a will. That's more important, I think, than getting tax advice. Now, obviously, I'm a tax advisor, as is James, so we think you should get tax advice. But firstly, get your will, or at least get the tax advice and get the will and do it very quickly. I'm always worried about people ending in a cycle of delays. It's a thing you can easily put off. and you end up thinking you get tax advice, that takes you a couple of years. Then you think you get a lawyer, and that takes a couple of years, and something happens before you've actually got the will in place. I think get the will, then get the tax advice and improve it. As if you have no will at all. Obviously, the ideal is you would take advice first, but just practically speaking or pragmatically, get your will. I don't know if you agree, James, but that's my approach.
Yeah, I mean, in an ideal world, we'd want people to come to us and say, what should we do? But, you know, practically, I think you're right. The important thing is they get something. And, you know, and actually as their advisor, make us aware of it. And actually ensure that we as advisors should ensure we have that dialogue with clients anyway. So it should come up as a conversation point anyway.
Yeah.
But yeah, I think you're right with what you say, Patrick.
I think, yes, just get your will in place. It can always be changed and improved, and that's relatively easy to do these days. So at least you're not going to have that accident on your way to see the tax advisor and find yourself without the will.
Actually, thank you. That's immediately prompted another question, which, if I may paraphrase, is I think the sort of suggestion is that the deed of variation rules are equally as good as a will. But I'm not sure if you can repair all defects that way, but a brief summary of the deed of variation rules, please.
The deed of variation rules allow within 2 years of death for the beneficiaries essentially to rewrite the will. So, you know, simple example I had a question about yesterday was someone came to me and said, my uncle has left his estate to me entirely. I want to share it with my brother in equal shares. What do I do? Well, I said, rather than receive all the assets and make a gift, because those gifts could have tax implications for you, best thing to do would probably be to execute a deed of variation of, in this case, her uncle's will, so that the will is essentially rewritten to leave half the assets to her and half the assets to her brother. That's essentially how a deed of variation works. That is not to say, however, that, you know, we can just think, well, there's no need to bother getting the will right because we can correct it afterwards. That's not strictly true. There would be all sorts of problems where, for example, there are minor beneficiaries, where I think you'd need to go to the court to ratify any change or any deed of variation that would otherwise affect the minor beneficiaries. You don't really want to go down that route. And whilst, again, I don't particularly want to make this a technical answer, if the will is creating trusts, or rather if the deed of variation creates trusts, because the tax advice is really we should have created a trust for whatever purpose, then those trusts created by a deed of variation aren't always as tax efficient, because for certain tax purposes the deceased is not regarded as the settlor, as they would be if they made the if they put the trust in their original will. Don't want to say any more than that, other than, you know, to emphasize that yes, they can be very useful, yes, they can put things right to a large extent, but they are by no means perfect, and it's not a reason not to get the will right as best as possible beforehand.
Yeah, I think I just echo that. If you've made a mistake in your will, it's not the end of the world, because deed of variation might come to your rescue. But leaving aside minor children, it does require all the beneficiaries to agree to it. So you only need one person to disagree, and the larger the estate, the more likely it is that someone has a contrary view to who should get what, and they disagree, and then you can't do it. So you might be able to solve the problems, but it's better to get it right in the first place. How are we doing, Steve? Any more?
Thank you. Yes, I do have a few. It's difficult to paraphrase this next one. It sort of starts off by saying, well, presumably the value of tax-efficient investments is about to increase as tax is about to rise. I'm sure we'd all agree with that. But it kind of asks which is the best one, which is actually quite difficult to answer. So if anybody fancies having a stab at answering that question, or perhaps comparing them for a moment or two, that would be helpful. Thank you.
Well, I'll have a stab to start off with, and then James.
A few.
I mean, tax-efficient investments. I mean, there's a range of them, and I think if we look at the ones that, well, I mean, things like individual savings accounts, your ISAs, and things like that. That's probably not quite what you meant, but taking advantage of the £20,000 a year you can put into a tax-free wrapper obviously makes sense. That 20,000 is I don't think it's been frozen officially like lots of other things, but it is staying the same this year as it was last year, which is £20,000. But that's quite a lot. It's per person. If husband and wife both put £20,000 in a year, that adds up to quite a lot over a number of years. So do that. I guess you were more thinking of SEIS and EIS type incentives. So seed enterprise investment scheme, that are there to encourage people with a bit of money to invest them in smaller, risky startup businesses. And yes, they're very advantageous. And in fact, if you can get the circumstances exactly right, and I think I may have mentioned them in one of our previous webinars, you can end up with some ridiculously high tax reliefs approaching 100%. But the basic rules are, for the smaller one, SEIS, you can put up to, I think it's £100,000 per year in. Someone tell me if I get these numbers wrong. I think it's £100,000 per year. And you get 50% income tax relief. So in other words, you spend 100,000, it only costs you 50,000. So that's quite good to start off with. You also get the ability to defer capital gains that you have of up to that £100,000. And half of those capital gains will become exempt, provided you meet the holding criteria, which are broadly three years, I think. For these things, usually it's 3 years. It's a bit more complicated than that. In fact, it's a lot more complicated than that. But broadly, you need to hold it for 3 years, meet the rules for 3 years. The company needs to meet the rules for 3 years, and then you're okay. You can dispose of it. You have no tax on any gain. If you've rolled a gain into it or deferred a gain into it, half of that gain will become chargeable, but the other half is exempt, and you've kept your 50% income tax relief. So that's very good. You can then go on, possibly in the same company, if they offer it, to make further investments under the EIS scheme, or you can go straight into an EIS scheme. These are much larger businesses, £7 or £8 million of turnover or assets. I think I can't remember the exact numbers, but they're fairly substantial businesses, some of them. There you get 30% income tax relief because you're not seen to be taking quite such a risk. But the limit you can put in per year is £1 million. And there are sort of quirks where you can get another million for certain types of more knowledge-intensive business as well. So you can put a lot of money into these, and that's per year. You get your 30% income tax relief, so £1 million costs you £700,000. You also, again, get the deferral of capital gains, so you could defer the gains on £1 million worth of, defer the tax payment on £1 million worth of gains into that EIS investment. Now, it will become taxable when you sell that EIS investment. Any gains on the EIS investment itself are exempt because of the relief, but the gain you've deferred would become taxable. One of the classic tricks we try to do, and this is hard to organise, of course, but if you can manage to die holding the EIS investment, then the gain that you've rolled into it or deferred into it dies with you because there is no capital gains tax on death. So that gets rid of the deferred gain in that scenario. And also, investments in an EIS company may well qualify for business property relief. So I think the nearly 100% relief I mentioned can apply where you get 30% income tax relief, say 20% capital gains tax relief because you die with it and therefore it doesn't become chargeable, plus 40% inheritance tax relief. That adds up to 90% relief in my book. So 90% and maybe even 98% if you roll the gain from a residential property into it at 28%. And you can get even better than that, actually, if you are using money, if you're a non-domiciled person and you use money from overseas, and bring that in under an investment relief methodology, such you avoid income tax on that as well. I think, I can't remember what rate I got to, but I think I got over 100% in the perfect scenario. So yes, they are very valuable. Hopefully that was a reasonable run through. I didn't miss anything too fundamental.
I think the only thing I would add to that is that the use of EIS, Visa and other, and SEIS is becoming more and more prevalent as high earners are unable to contribute to personal pensions. You know, they need somewhere to invest tax efficiently. So I think we're seeing more and more investment into these schemes, and as a result, investment advisors are perhaps better able to speak to clients about them. So that's perhaps what I would say.
The other sting in the tail to that is as more and more people use things, you do tend to get governments looking at them again and thinking, maybe we should simplify this, which generally means take away some of the relief or restrict it a bit more. But we'll see. So far, they're very good. I think probably we're just about reached the end of our time, actually, Steve. So if there's one more, perhaps we can do one more.
Yeah, I think I did read actually this morning that the ISA limit's probably going to be frozen until at least 2023, actually. So I think that's probably bad news for savers. Yes, well, I've got a number available.
We had better stop fairly soon, since we said
okay.
Let's do one.
Okay. Oh, well, there's one from obviously from someone who's feeling quite optimistic, which asks, should income from companies be deferred in the hope tax rates fall?
It is optimistic. I mean, who knows what will happen? But I think the direction of travel looks more likely to be upwards in the reasonably near future than downwards. Things may, of course, change, but income tax rates, I would have thought, are unlikely to come down from where they are. Hopefully, they're relatively unlikely to go up too much more, but I think, if anything, they're more likely to go up one way or the other than go down. Corporate tax rates, that probably depends on what happens internationally. 25% is a reasonable middle ground, or slightly better than middle ground for a country like us to have. So it's competitive without being super competitive. If other countries continue downwards on the level of their corporate taxes, which may happen, then we may well have to follow them to a degree. But equally, if they go up and the average becomes higher than 25, we may be tempted to increase our rate as well. Don't know if you've got anything else on that, James.
No, I don't think so. I mean, it's a question of, it'll be very difficult to advise someone to wait for tax rates to fall. You know, I think you'd be waiting a long time. I'd sooner have a conversation about how to extract it efficiently, how to take advantage of the tax reliefs that are available.
I'm more inclined to suggest people get money out sooner because of the social care levies coming in. You want to get it out before then if you can. If you've got money to make in a company for however restructuring things and making profits in the company as a result, or gains in the company, you want to do that before 2023, so you keep the 19% rate and don't get caught by the 25% rate. So it's more a case of accelerating than slowing down, I think, at the moment.
Yeah.
Okay. Well, thank you very much for listening to that slightly different version of a budget webinar. I hope it was useful. I can see that we had a fair number of people on, and most of them stayed right to the bitter end. So thank you very much for that. We bring it to an end now, but thank you for listening, and we look forward to seeing you at the next one, which I think is group structures, if I remember rightly. But we've sent a list round so you can see what we're planning, and hopefully we'll see you again soon.